Hello and welcome to the webinar on what is the Employee Retention Tax Credit. So today we're going to be talking about this particular program and what the Employee Retention Tax Credit is, how it works, and how you claim it. Some key points before we dive in. The Employee Retention Tax Credit is a benefit for keeping people on the payroll. Essentially, what happened was the federal government set up this program so that if you had certain impacts of COVID, and we'll talk about what those specific impacts are on your business, and you kept your W-2 employees employed, then they're giving you this tax credit to encourage you to stay in business and keep those people employed into the future. This is easier than the PPP. It's going to be a little different, but at the same time, I would say having worked a lot with the PPP, this is easier. It's payroll based just like the PPP, but there's no constraints and there's no forgiveness needed. So there isn't this like 60% on this, 40% on that, and you can spend on these things. Now, keep in mind, because you're going to hear this from other people, the mainstay of the program, and we'll talk about one exception, ended on September 30, 2021, but you can claim this retroactively. So do know as we talk about this, even though the program is over, you can still go back historically, and if you were eligible, claim those credits. So a lot of people ask, so we want to get this out of the way. Why haven't I heard about this? Right? It sounds complicated. And as you're going to see, it really isn't incredibly complicated, but a lot of people hear the name and they don't talk about it, don't share it with other business owners because of that. If you're a nonprofit, as I know some of you are, a lot of nonprofit leaders will say, well, we don't pay taxes. This is actually on your payroll taxes. So if you have W-2 employees, this does apply to you. It's not on your corporate taxes. Many people say, well, my accountant didn't tell me about it. You know, as you're going to see, this is mainly and typically done through your payroll company. So usually your accountant isn't involved in it at all, and that's why they may not have mentioned it. And in terms of it not being in the news, I have yet to solve that one. We're not sure why it isn't in the news. It's a really good program, and it's one that is bringing in money to other childcare providers in other states. So let's talk about the three basic steps for it. We're going to go into all of these in detail, so don't worry. One, you start by you self-certify a trigger. So there's certain triggers we're going to talk about that are ones that say that you've had an economic impact of COVID that is strong enough to make you eligible for this program, and you self-certify that. So you're going to just yourself keep some records of that. You certainly want to, but there isn't, you know, some sort of application process around that. Second, you're going to alert the IRS through your 941. The 941 is the quarterly payroll tax form that you have to send to the federal government if you have W-2 employees. So we're going to talk about how you do that, but that's the main mechanism. That's really the hardest part, is getting that 941 in. And then finally, you receive a check. And the check is going to be one of those rainbow colored IRS refund checks. It's just cash. There isn't a forgiveness process. If you notice, there isn't a step after that. So let's talk about those triggers, right? One, revenue reduction. This is the hardest part of the whole thing. So if you can get this part, we're going to be good. What you want to look at is quarterly revenue. So everything you took in a given quarter. The baseline are the 4 quarters of 2019. So quarter 1, quarter 2, quarter 3, quarter 4 of 2019, before the world ended with COVID. And what you want to do is compare each quarter's revenue to the corresponding quarter in 2020 and 2021. So for example, you would say quarter 1, 2019 to quarter 1, 2020, quarter 1, 2019 to quarter 1, 2021, quarter 2, 2019 to quarter 2, 2020, quarter 2, 2019 to quarter 2, 2021. So we're always returning to 2019 before the world ended as our comparison. And what we're looking for is to trigger it is a quarter where you have a 50% or greater decrease in revenue from 2019 to 2020. Once you do trigger that in 2020, it's going to continue to be eligible until you have less than a 20% reduction. So what does that mean? Keep the numbers easy for me. Let's say in 2019 quarter two, you made $100,000. And then in quarter two, 2020, because of COVID, you only made $49,000. Well, that's a 51% reduction. So now you've triggered the ERTC for quarter two, 2020. Now let's look at quarter three. So let's say quarter three, 2019, again, you made another $100,000. And then in quarter three, 2020, you start to improve a bit. Maybe some government grants came in, some families returned, and let's say you made $70,000. Well, that's still a 30% reduction, right? Because you made $100,000 in quarter three, 2019. You made $70,000 in quarter three, 2020. That's a 30% reduction. So that trigger continues. Now we can look at quarter four, etc. In 2021, excuse me, we're just looking for 20% reduction. So if we take the same example, and let's say we take quarter two, 2019, we said it was $100,000. In 2021, quarter two, if we let's say made $80,000, well, that's $20,000 reduction from $100,000 to $80,000. So that triggers it. The next trigger is if you have partial cessation of business or a closure. Now, this one's a little weird. So the closure is easy, right? Closure means that you had a government ordered closure. So many, states and localities, this could be at the state or local level, had some closures right at the beginning of the pandemic, right? But the partial cessation is a 10% or greater reduction in the capacity to produce goods or services. Now, again, this has to be by government order. So this can't be the government saying, a local government or a state government saying, you really should social distance. It has to be, hey, provider, you have to engage in social distancing. Now, the capacity is a key point here. So what we're talking about is not enrollment, but how many kids could you serve? So the example the IRS uses is a restaurant. Let's say you had a restaurant and you had 10 tables in the dining room, and you had to wheel 5 of those tables in back so you could distance the other ones from each other to comply with government order. Well, you've had a 50% reduction in capacity, right? Because you have half the tables you had before. If you notice, the IRS isn't saying, hey, how many people showed up for lunch that day or dinner? They just said, normally you could serve 10 tables worth of patrons. Now you could serve 5 tables. That's a 50% reduction. So for a childcare business, what we're looking at here is when you think about your license capacity, if let's say your license capacity is 100 children, and because of social distancing, let's say you had to reduce the number of classrooms you had, yada, 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 at most you can only serve 80. Well, that's a 20% reduction. You went from 100 that you could serve to 80. You notice, again, I didn't ask how many kids showed up, how many kids were available or you were serving actively, because that's not the question they're asking. The reason why they're asking this, by the way, is because what the IRS was afraid of is what happens if just people don't like you? And I know it's not you, right? But there might be other childcare businesses people don't want to use, right? And so what they didn't want to do was have a situation where they're providing funds to a business because it wasn't really COVID. They just weren't very good. So instead of saying what's the demand look like for your services, they said, hey, how many could you serve? Because if you had to reduce capacity, that means it was due to government order around COVID. That's a pretty good idea that you had some pretty big impacts on your business. The last one is a more recent one, and this started really in earnest back in August of 2021, and in March of 2020, excuse me. This is around a new business, and so what this is to what this is about is that, as many of you know, if you started a new business after February 15th, 2020, in the pandemic, you weren't eligible for a lot of the funds that were out there. And accordingly, the IRS said, well, hey, let's give them a special category. And if you were started operating on or after February 15th, so this is a new operation. It isn't that you opened up a new location, right? It's a new company starting operations, and you have under $1 million in annual revenue, then you would be eligible as a recovery startup business. This is the one exception. As I mentioned, the program ended 9/30/2021. For this particular trigger, you can use both Q3 and Q4 of 2021. Those are the only 2 quarters you could use for it, but it is a nice bump if you're a newer business. You know, a couple of exceptions to these rules. If you had a PPP that you were using for your salaries or using Family First leave, you can't then, quote unquote, bill that time to the employee retention tax credit, right? And that it makes sense. If you slow down for a second, it makes sense, right? The federal government was already paying for your salaries at that point, so you can't just double bill them for the salary. So that's just a caveat here. So if you look at the amounts, right? Like, so how much are you getting, right? In 2020, for an eligible period, right? Let's say it's the quarter, you would get 50% of the wages and salaries in that given quarter. 50%, right? Of the first 10,000 for full or part-time employees. So if you were to have a person who made $10,000 over the year, you would get 5,000 back, right? And that was an annual limit. In 2021, it got a lot better. So in this case, in 2021, it was 70% of the first 10,000 for full or part-time per quarter. So in other words, now you have up to $7,000 per employee that you can claim in credits. If you're a larger organization, you have 100 plus employees in 2020 or 500 or more in 2021. We get into some rules around workers being idle. Look carefully at that. I know for most childcare businesses, you're not hitting those numbers, so we're not going to go into great detail on those today. So now you need to self-certify that trigger. So as we talked about, there are 3 triggers there, right? And those are going to be ones that you want to definitely have a record of, right? And please, throughout all of this, keep up to date if there's any government changes, right, along the way. But you're going to want to have a record of that in some way, right? So maybe it's here's the government order we had to comply with, and here's how much it reduced our capacity from licensed capacity, or here's just a simple spreadsheet that shows we went down in revenue from 2019 to 2020 Q3 by 50%, and you can see it in the spreadsheet. Very simple. Now that you've self-certified, you want to alert the IRS through your 941, right? And what you do typically is you alert your payroll company. So again, you're not going to your accountant, you're going to the payroll company, and you're saying, hey, ADP, I'm eligible for the employee retention tax credit in Q3 of 2021. And they will then give you instructions on how you amend the 941. So really what they're doing is they're going to do a form that says, hey, Gary was eligible for the employee retention tax credit. He didn't realize it, but we're claiming it now. That form is then typically electronically sent from your payroll company to the federal government, and then you receive a check. Now, keep in mind, there's a big backlog on these things. And in general, the IRS has been behind because of all the different tax rules and changes that have occurred. So this can take months. This is not quick money, but it does come. And when it does, there's no additional effort needed, no restrictions on the money. It is a cash refund check. You may need help on this. If you do, we have free business coaching available. You can view resources at indianaspark.com, and there's a training calendar there, which has some ability to learn more. There's also free one-on-one business coaching, and you can sign up for that here on the link that you're seeing below. And that will allow you to talk to a business coach in either English or Spanish, whichever you prefer. And we can specifically talk about your needs. We hope you stay well and that this information is useful and helpful. Thank you.